On the 1st of June 2026, BHP shares closed at $61.52 after touching an intraday record of $62.30. That same day, the ASX 200 finished virtually flat, down just 2 points, or 0.03%. The materials sector rose 2%, while healthcare fell nearly 2%. For a stock that had already added almost 16% in a single month, this was not a consolidation, it was a separation event. The question worth asking is not whether BHP can go higher. The question is what the market believes it owns when it holds BHP at this price. Because 3 different holding theses are simultaneously priced into this stock right now, and they are not all pointing in the same direction. The first thesis is the familiar commodity supercycle play. Iron ore is trading north of US $109 a ton, defying analyst forecasts that had penciled in a retreat to as low as US $80. BHP's scale and low-cost positioning mean that at these iron ore levels, cash generation is substantial. That thesis is simple and it is visible in the numbers. The second thesis is a geopolitical inflation hedge. Brent crude rose 2.4% to $93.32 a barrel on the same day BHP set its record high. The Iran war and uncertainty about the Strait of Hormuz are keeping oil elevated. Elevated oil lifts commodity input costs broadly, which historically lifts commodity producer equities as a relative store of value. BHP in this reading is not being bought because iron ore is strong. It is being bought because the world is less stable. The third thesis is the copper transition compounder. BHP's half-year results to December 2025 upgraded copper production guidance. Analysts at Red Leaf Securities argue BHP is gradually shifting from a traditional cyclical miner toward a diversified industrial metals compounder, structurally supported by electrification, grid investment, and AI-related infrastructure. In this reading, the stock deserves a multiple premium over pure iron ore peers. Here is what is easy to miss. These 3 pieces require 3 different exit conditions. The supercycle play exits when Chinese steel demand softens. The geopolitical hedge exits when Iran uncertainty resolves. The copper compounder has no near-term exit trigger. It is a multi-decade thesis. A holder who entered on Thesis 1 may be sitting on a position they would not have built under Thesis 3, at a price that only makes sense under Thesis 2. The ATH is not the anomaly. The compression of 3 incompatible theses into a single price is. DZ Bank's move to upgrade BHP from sell to hold this week, with a price target of A65 against a then close of $62.31, is instructive here. The broker did not turn bullish. It conceded that its previous bearish thesis had largely played out. That is a different thing. And the broader analyst community has settled into a consensus that clusters average targets around A57 to A60, a range that sits materially below where BHP is trading today. The majority of coverage now sits at hold, market perform, or sector perform. In other words, the street views BHP at or slightly above fair value after its run. That gap between the consensus target and the live price is not a buy signal hidden in plain sight. It is the market explicitly pricing a premium for one of those 3 theses, and the current price only works if the right thesis is the one that lasts.
Most of the attention on BHP this week has focused on what is going up: the share price, the copper production, the market cap. What deserves equal attention is a structural threat to BHP's largest revenue line that BHP's own management has publicly flagged as growing more complex each year. Iron ore still accounts for the majority of BHP's revenue and profit, and sitting across the table in future pricing negotiations is an entity specifically designed to shrink BHP's margin on that revenue. CMRG, China Mineral Resources Group, was formed in 2022 with backing from the Chinese government. Its explicit purpose is to centralize purchasing negotiations and increase China's bargaining power over global iron ore prices. It represents the majority of China's steel mills. BHP was locked in negotiations with CMRG for several months earlier this year. Those negotiations concluded last month. On the surface, a conclusion sounds like resolution. But Tim Day, BHP's Western Australian iron ore asset president, said something quite different at the Australian Financial Review Mining Summit in Perth. His words were precise. It will be on again next year, and it is getting more complex and will just continue from here. He added that China's power and size will continue to play that way on pricing over time. This is not a distant geopolitical risk. This is BHP's own iron ore president telling the market that the pricing compression pressure from CMRG will intensify annually. The current iron ore price of US $109 per ton reflects market conditions today. The CMRG process is designed to systematically reduce what BHP can extract from Chinese buyers over time. Here is the assumption that the bullish consensus on BHP's iron ore earnings appears to be leaning on, one that Day's comments explicitly put under pressure. The consensus calculus treats iron ore price as primarily a function of Chinese steel demand and global supply. But CMRG introduces a third variable, Chinese institutional purchasing power. This is a variable that operates independently of demand levels. Even if Chinese steel demand stays firm, CMRG can negotiate lower prices on behalf of that demand if it consolidates enough purchasing volume. The hidden assumption in the bullish iron ore thesis is that price is demand-determined. CMRG is a direct challenge to that assumption. If the market is pricing BHP's iron ore earnings at $109 per ton forward, and CMRG has already signaled, not because demand is falling, but because the pricing mechanism itself is changing. This matters for the valuation debate with particular sharpness. BHP's revenue CAGR has been negative at 1.7% over the past 3 years. Profit CAGR has been negative 11.3% over the same period. The current 3.51% dividend yield sits well below BHP's 5-year average of 6.86%, not because dividends are expected to rise, but because the price has run far ahead of the dividend stream. If iron ore pricing power transfers incrementally to CMRG over successive annual negotiations, the earnings recovery the current price is discounting may not arrive on the assumed timeline. The point is not that BHP's iron ore business is in immediate danger. The scale and cost structure BHP possesses mean that even at lower prices it remains viable. The point is that the standing read on BHP's iron ore earnings quality, the assumption that iron ore prices are a commodity market function, is shifting toward being a political function, and that shift is structural, annual, and cumulative. The question a holder should be sitting with is not whether BHP's iron ore business survives CMRG. It is whether the timeline on which BHP's copper story fully offsets iron ore pressure is shorter than the timeline over which CMRG gains structural leverage.
1 week before BHP printed its all-time high, a different story was running across multiple major Australian outlets. It did not move the share price at the time. It may not move the share price this week either. But it represents a third dimension of pressure on BHP's standing, read that compounds the CMRG risk rather than running parallel to it. Multiple reports, led by The Guardian and picked up by Renew Economy, revealed that BHP has scrapped plans to build a Pilbara plant that would have materially reduced its operational emissions. Internal documents leaked to media showed a broader walkback of decarbonization commitments made when former Chief Executive Andrew Mackenzie declared in 2019 that BHP would lead the corporate world on greening. BHP has now admitted to stalled emissions reductions. Climate Minister Chris Bowen responded publicly, stating he had made it crystal clear to BHP and other large polluters that they must cut emissions on site. The West Australian Premier added that miners have a moral obligation to decarbonize. What matters for a BHP holder is not the environmental dimension of this in isolation. It is what happens when regulatory pressure converts from language into policy. The Australian government has set a trajectory toward mandatory emissions reduction frameworks for heavy industry. BHP currently operates in Western Australia with substantial diesel dependency. If on-site emissions reduction moves from a political expectation to an enforceable regulatory obligation, the capital expenditure required to retrofit BHP's Pilbara operations at scale is not incremental, it is structural. At a market cap of AS $316.62 billion, BHP is the single largest company on the ASX. The emissions liability is not priced into the current multiple. The DZ Bank upgrade to hold at a $65 target does not reference the emissions regulatory trajectory. The Red Leaf Securities Buy recommendation focuses entirely on copper demand and iron ore scale. Here is the two-path tension a holder must carry. Path 1. The Iran war keeps oil and commodity prices elevated. The copper electrification thesis delivers on its multi-year timeline. CMRG's leverage grows slowly, and the emissions liability is managed as capital recycling rather than forced expenditure. In this path, the ATH is not a ceiling. Path 2. A US-Iran deal resolves faster than expected. Trump's Truth Social post on 1 June indicated Iran was moving toward compliance. The geopolitical premium compresses. The CMRG pricing trend accelerates into the next annual negotiation, and emissions regulation in WA firms up.
In this path, the three theses that currently converge to support BHP's price at $62 begin to separate, and the consensus analyst target of $57 to $60 becomes the gravitational center rather than an underestimate. The checkoff anchor here is the Strait of Hormuz. BHP hit its all-time high precisely as oil spiked on Hormuz access uncertainty. Any credible diplomatic signal that the strait is reopening, or that US-Iran talks have progressed to a formal ceasefire, tests the geopolitical holding thesis in real time. If BHP's price holds above $60 on a Hormuz reopening signal, the copper compounder thesis is doing the work. If it retreats toward consensus, the geopolitical premium was carrying more of the price than the underlying fundamentals warranted. That distinction is the monitoring variable for anyone holding BHP above the analyst consensus range today. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.